Good afternoon, everyone, and welcome to Stock Market Today. It's Allie, Coram, Ned Carson with a breakdown of the action in today's session and an update on what went down this week. We'll also provide a little bit of a look ahead to next week. But Ed, even though we did get a bit of a bounce on Friday, it's looking pretty bleak out there.
Yeah, you can't get excited. It's like don't get excited about dead cat bounces in a bear market. It was another week of big selling and big losses. The major indexes are all around their lowest levels since late 2020. Not a lot of reasons to be excited. There are a few stocks we want to take a look at: BYD, Enphase Energy, and SQM, which are acting relatively well, but have to put that in perspective.
Yes, and we definitely will. So let's take a look at the major indexes. On Friday, we had the NASDAQ up 1.4% for the day. The Russell 2000 up 1%. The S&P 500 also in positive territory, up about 0.2%. The Dow did close slightly lower, down by about 0.1%. So Ed, seems like technology was bouncing today, but that's been a big beaten down area over the last number of months.
Yeah, you can see how much damage. We were trading over 16,000 in November. Now we're below 11,000. And it's also small gains versus big losses really make a difference. We were up 3 days this week. And yet, if we go to the weekly, we were down more than 4%, I believe, on the NASDAQ. And I think that's the case for all the major indexes this week of big losses like that. You can see really coming down hard. So that's just pretty fierce. And there's not many stocks that can withstand that when the market is so overwhelmingly negative. Even stocks that are holding up well, and of course there's always going to be a few that stand out and move higher, but there's plenty of stocks that have strong relative strength and their charts still look pretty crummy.
Yeah, down, but yeah, relatively good doesn't mean they're moving higher. So let's also talk about key levels here on both the daily and the weekly chart. So this week's significant in that we did undercut the lows from earlier in May after that resistance at the 10-week line for all of the major indexes. So even though we finished off of the lows for the week, it looks like we are now testing the lows from late September 2020, Ed.
That's right. That's a key level, and all the major indexes are coming back toward their pre-coronavirus highs. For the NASDAQ, that's around 9,800, just below 10,000. I think the S&P and Dow are as close or even closer, depending on how you look at it. So the S&P had the advantage of a lot of energy stocks, which had a terrible day today. But obviously, that's been a sector that has helped the S&P outperform maybe its peers. Yeah, that one's coming down. There's all these resistance levels. You could find support at these areas. Doesn't mean it'll have to hold. There's plenty of places where you could have said, oh, it might find support here. And, maybe it will. But right now, you just see that direction, pretty powerful slide. And let's face it, the Fed is raising rates. It's sort of at the start of an aggressive rate cycle. The economy is heading toward a recession, it appears, or at least that's the concern. And inflation is very high. So in that situation, the Fed's going to keep on raising rates for a while, but the economy is already showing strain. So it's not a situation that seems to be positive for markets. Eventually, the markets will price it in. It'll look down the road and see that light at the end of the tunnel. But we're just sort of in the beginning of that tunnel. It's again, anything can happen. But investors should at least be aware of that macroeconomic broadcast and just say, I hope and wish things get better. That doesn't mean it will.
Absolutely. And we can also take a look at the IWM ETF, which tracks the Russell 2000. Looking at it on the weekly chart, coming down to its lowest levels since October 2020 or so as well, in a hard hit week, but a hard hit week all around. I did briefly show the 10-year Treasury yield, so we could just pop that up here off of its highs for the week, but it's been a big couple of weeks for the 10-year yield.
Yeah, really big weeks. It rose to an 11-year high of well over like 3.48. It was and it was a really amazing move. but then it came back down. It's very volatile because, just like the stock market, the bond investors are trying to figure out, well, what should I be worried about? Inflation, or should I be worried about recession? And on the long end, it's a combination of those factors. On the short end of this yield, it's going to be more about what the Fed does.
Right.
But here, it just makes it really tricky. It makes it hard to know, what do you know? It's like, well, what do I know? What can I hold for certain? And it's just not even for bad news, you don't even know what is certain right now. And that just makes it difficult to take any kind of position.
It does. Yeah, a lot of unknowns out there right now. And let's take a look underneath the surface at how some of the industry groups fared. XLE, which is a proxy for the broad energy sector, big weightings in Chevron and Exxon, but a very good visual representation of the damage done to the leading industry groups related to oil and gas this week. So a very different picture here, a personality change almost, for a lot of these stocks in this group, these related industry groups in oil and gas, which has been the big leading area this year, Ed.
Yeah, and of course, if oil prices and natural gas prices rebound, you could imagine these coming back. So it's not that this group is necessarily finished, but yeah, serious damage, plunging through the 50-day line in such a decisive way, in such massive volume. And these are some of the names are much worse. This is a fund dominated by, as you say, Chevron and Exxon. I mean, some pretty steady eddies, and look at that action. So that suggests there's going to be time to repair. And so when even the energy sector is down, that's a concern. Now, on the bright side, one of the reasons why we're so worried about a recession is that getting energy prices down is just going to be a real challenge for the Fed. So that means they have to be even tougher on other things to get that. So in theory, if energy prices come down, that could be and sustained and, come down, then that would make the job easier for the Fed. But that's sort of like getting too many steps down the road. For energy stock investors, it's a very bad week for oil and gas. And it might take a while for this to come back.
Exactly. Yeah, down 17% this week. That's pretty dramatic. Closing sharply below the 10-week line for the first time in its run this year. So a lot of oil and gas stocks look like this, or kind of like this. And when we see a stock closing decisively below the 10-week line, our research shows that at the very least, the stock is most likely going on to build a new base, which will take a while, or could take a while, or it could be a signal of the end of the move. Like you said, there's a lot of other factors that are at play here, Ed, but very notable bearish action this week in the group.
Yeah, and it's like, as you say, this really haven't seen this kind of action for a long time in this group. So definitely suggests a character change. We'll have to see if that really sticks, but definitely stands out.
Yes, it does. Okay, elsewhere, let's take a look at the metals and mining stocks at XME. So further deterioration here, down over 10% for the week, well below the 40-week line here, an area where it did test with some sideways action from mid-2021 through early 2022. But in the first couple of months of 2022, this was another area. It wasn't just oil and gas, but it was other commodity related stocks like the metals names and mining names that had notable moves. So to see further deterioration in this group is disappointing as well. And we've said in a bear market, they get them all. So even the leading groups, this one hadn't been leading for a while. It was trying to get back on its feet, but turning tail in a significant way.
Yeah, I mean, obviously the first couple of months we were more worried about inflation, the commodities, like, hey, it'll keep going up. But now it's more recession. And we had 4 steel makers either report earnings or give good guidance. I mean, some really good news from at least the steel side. They still all fell. It's just like, no, we don't care. We don't care. That's the environment we're in.
Yeah, those earnings reactions, it can tell you a lot about the kind of environment we are in. And we also want to take a look at XLV, the healthcare ETF, down 4.5% this week. and hitting its lowest levels in quite a while here, Ed. I think going back to, it looks like, spring of 2021.
Yeah, and this had been a strong group. This is one of the non-commodity groups that was doing well for a while, and for a while it didn't do that badly, but now, yeah, it really does seem to be breaking down. A variety of reasons, as you said, they come for them all, and drugs and health insurers, a lot of those look pretty weak right now.
They do. And next on our list, let's take a look at ARKK for the week, down 3.4%. Closing at its lowest level in quite a while. If you go to the daily, we did get a bit of a bounce. We were talking about at the beginning of the show. So Friday up 4.8%, but still down for the week here. Ed, your assessment of what we're seeing, is this just more temporary bottom fishing? What do you think?
It might be, and it's hard to say. It is nice that it hasn't undercut the lows yet, but it's sort of like it's not that far. It was like one bad day, and you could easily do that. So that's something there. But yeah, it's been a long slide for this one, but it hasn't undercut yet.
Mm-hmm. So something that we talked about on IBD Live this morning is some of the stocks, maybe they don't have a relative strength line at highs, but the likes of Google and ServiceNow and some other stocks that have strong or decent fundamentals and stable earnings, and if they haven't undercut their recent lows, maybe that's a subtle signal underneath the surface that they're starting to show a little bit of relative strength versus the market, which when we were looking at the indexes on their weekly charts, undercutting their lows from May. So if we're seeing stocks that are not undercutting, maybe if they continue to, and that's an if they continue to have that positive divergence, those are some potential watch list names.
Yeah, you just keep on looking for things, and they may fall off, but you keep looking for those names, and yeah, that's definitely some of these ARK names actually are holding up a little better than the indexes.
Mm-hmm. All right, well, let's take a look at 3 potential watch list stocks, shall we? Like BYD, China EV stock, up over 4% on Friday after coming down to its 21-day line in a brief pullback the last couple of sessions, as it works on the right side of a cut base with a depth of 48%. So that's a pretty deep base, Ed, but big move that it's made from this low in earlier in May at 26. And on a weekly chart, in a little while, we will see a handle show up from pattern recognition.
Yeah, so pausing was sort of a nice thing, and really it would be great if this could pause for several weeks, because let those moving averages catch up, maybe even have a handle that's long enough to be a flat base. We'll see. Right now, a lot of China EV stocks are running higher. So there's sort of momentum and China stocks in general. I mean, it's weird that that's now becoming almost the safe haven. That's a crazy kind of world that we're in. But this is doing well. There's a lot of positives, of really strong growth. This is sort of like leading that EV space. So it's nice to see that space moving, and this being the leader in it right now in terms of the stocks. So definitely worth watching. Yeah, but it's also run up a lot. The relative strength line high, but yeah, but it would be really nice if it took a longer break here.
Mm-hmm. Because today it finished about 14% above the 10-week line. I think you make a great point about seeing an actual base form here, not just a handle, because and I mentioned the depth of the base being 48% because another stat from our research shows that bases with a depth of greater than 40% have a higher likelihood of failing. So if it can form a new tighter base here, that would be a welcome development, not only for the stock, but the market needs time to get back on its feet too. So if you're starting to see setups and the market cooperating too, that's ideally what we want to see.
Yeah, that's exactly right.
Okay, next on our list, let's take a look at solar stock, Enphase here. Looks like it had a breakout in recent weeks, didn't quite work out, Ed, but some supporting action this week, which is good. So it's interesting because usually when we talk about a breakout failing, that's a negative, but clearly this is a positive chart in the current environment.
Yeah, I mean, it's weird to see that RS line so strong, but that's the way we're at. Look, one thing to be noted that this stock rises a lot every day. I mean, that's the character of the stock. You buy it, it's likely to move 5-10% where you bought it within a few hours. Nice rebound above the 50-day and 200-day line. And while the breakout above 193 failed, it does now have a new handle that you get. It's not going to show up. It doesn't show up on MarketSmith that way, but that's the handle. I suppose there could be a downward sloping trend line. But that would be the official buy point right up there at that top. It's interesting how well solar stocks did today, not just Enphase, on a day when oil stocks went down so much, because there is sort of they often will run together, not one-to-one by any means. So this is volatile, but strong growth is seen here. There are a lot of names that are coming up in recent days and weeks. So definitely one to be watching here.
Mm-hmm. Yeah, definitely a high beta stock here, but finding support where we'd like to see it. So we'll have to see if it can continue to hold up. And last but not least, we want to take a look at SQM, Sociedad Química y Minera, in the agriculture chemical group. So a fertilizer stock here, which did round trip a nearly 30% gain. But not only is it finding support at its 50-day line, but right around a prior buy point. So triggering a sell signal, but also we're keeping it on our watch list. Maybe this one also just needs a little bit of time to form a new base here.
Yeah, I mean, look, almost everything is pulling back. So like BYD has a 48% base. This one round trips a 27% breakout. So there's going to be damage on a lot of charts. There's very few things that are going to look really ideal, but it's finding support where you'd like to. And so while people who had bought it earlier probably should have sold as it was coming back down, now it could present an early entry if it rebounds from the 50-day line powerfully. Again, you'd have to really, in this kind of environment, sometimes you have to let stocks go. I mean, it's how much do you want to be doing that? But a nice bounce off the 50-day line, breaking that trend line back above the old buy point, that would be a positive signal. Look at those fundamentals. The fundamentals look tremendous. I mean, fertilizers have been doing well. Lithium, tremendous growth. So there is a lot to like about this stock, and really, yeah, it's come back down, but it's held up so much better than just about everything else.
Mm-hmm. And you're right. Not only a fertilizer play, but a lithium play as well. So yet another stock for our watch list. So we'll keep an eye on it. And to your point about there's not going to be a lot of charts out there that look quote unquote ideal right now. And maybe for the handful that do, then maybe they're not up to snuff on the fundamental side. Maybe they have great technicals, but poor fundamentals, or maybe it's in more of a defensive group. And once you see a market rally, then that's not going to be a group that is taking center stage. So all sorts of things that we are thinking about while we continue to build our watch lists. And Ed, I think in a time like this, there are plenty of reasons to be bearish. We've talked about a third leg down for the NASDAQ that could have a potential depth of 20%. How is it important, or how important is it, would you say, for investors to remain neutral or to try to be open-minded in this scenario? Because we want to be in the present and recognize the current market that we are in, but we have to make sure that we're at the same time, staying nimble.
Yeah, I mean, look, one of the reasons to stay on the sidelines is that it's easier to, you can watch it with a level head, watch the carnage, and just sort of watch that and not be hoping or get despondent or both. Mm-hmm. You want to be, staying, you always want to try to keep the emotion out as much as possible when looking at stocks, looking at the market. And it's so important in this kind of environment. So because you want to be, okay, the market's not doing well, and you can see that on the sidelines. And then if the market does turn, you have to be ready to switch that mindset, not rush into the market when we start seeing positive signals, but saying, well, maybe I'll tiptoe in a little bit. Maybe I'll go in a little bit and see if things go. And if things work, I'll keep on building in there. But you don't want to get into a permanently bullish or bearish mindset, because the market isn't permanently bullish or bearish. So you want to be listening to the market, not having a mindset that you'll either miss out on big gains or suffer massive losses if you're not paying attention to what the market is saying.
Exactly. And that's why we analyze the technical health of the major indexes every day, because why make a projection for the next day or week or month when that could all change with 1 or 2 or 3 or 4 days of trade for the worse or better. So that's why we look at things day by day and adapt as needed when new information presents itself. It's why we do scenario analysis for the bear case and the bull case. So it's important to have all of those scenarios in mind so you can be ready to act as necessary.
Yep, and hopefully while doing all this, you build up your watch list and keep on changing that. And so when the uptrend is ready, your mindset is, not only do you change your mindset a little bit, but you also have then a list of stocks and well, these might be the potential leaders. And so you're ready to go. So you definitely want to stay engaged, but just off to the sidelines right now.
Exactly. And speaking of that watch list, coming up at 5 p.m. Eastern, David Ryan joins me on Stock Tales, and he's going to be going over his bull market prep checklist. Yes, we are in a pretty terrible bear market right now, but as Ed said, we need to be looking ahead and preparing for what's to come, even though we don't know when that'll happen, when conditions will substantially and meaningfully improve, but we've got to be ready for that. So I'm looking forward to hearing more from David Ryan and having him share with our audience his checklist and how he is preparing for the next bull market. And you can catch that live on my YouTube channel, youtube.com/Alissa Coram IBD, coming up at 5 p.m. Eastern. So looking forward to that. Monday is the Juneteenth stock market holiday. So not only is the stock market closed, but we will not be having any of our normal shows. So we will see you back here on Tuesday for IBD Live and Stock Market Today and all of our regular programming. So we hope everyone has a great weekend. Thank you, Ed, and thanks everyone for watching.